webinar. Appreciate you all joining us tonight. I'm Nick Elder in Investor Relations, Ironton Capital. I'm joined by some fantastic hosts today. We've got Joe Massey. Joe, how you doing with Castle and Cook?
I'm doing great, Nick. Thanks so much for having me on. Always enjoy being here with you guys and appreciate you making the time.
Yeah, we're looking forward to seeing everything that you're going to present here today. And we're also joined here by Lon Welsh, CEO of Ironton Capital and your Castle. How you doing, Lon?
Fantastic. Thanks for having me. It should be a great discussion.
Awesome. We have two other co-hosts today on the webinar. We've got Brett, and we've got Stacy with Blue Federal Credit Union. How are you guys doing?
Doing great. Appreciate the chance to be here.
Awesome.
Fantastic.
So since you guys are new here, we'd love, if you don't mind, we'll start with you, Brett. If you want to go into, just do about 30-second introduction, who you are and what you do at Blue Federal Credit Union, and then Stacy will follow up with you afterward.
Sure. Just quickly, I'm a business and wealth relationship manager. I work for Stacy. I focus on commercial lending. That's me in a nutshell.
Love it.
Okay. All right. I'll jump in there and follow. Stacy Orrick. I've been in the banking space, finance space for about 22, 23 years or so. And then most recently with Blue for almost 3 years. So right now I currently run the commercial mortgage and wealth divisions for Blue. So I'm excited to just chat about a few opportunities about strategy and how to get collaborative when managing your business and your properties.
Awesome. Well, thank you both for joining us. We're very excited to have you. Before we get into it, we've got a couple slides here to go through before I turn it over to Joe and Lon here. So many of you may have seen this before. This is the beautiful love letter from our attorney that we put at the beginning of every one of our presentations. As we go through a lot of this information, you'll see some forward-looking statements. You'll see some information about some of Ironton Capital's funds. As always, before ever making any kind of decision to invest with us or with anybody, please review with your attorney, CPA, financial advisor, whomever, partner, whomever helps make your investing decisions. So please make sure that you get everybody involved before making any type of investment decision.
Perfect.
Joe, you want to head? There you go.
Yeah.
We'll actually just turn this over to you, Lon, since your name and face is right on this slide. So everybody, Lon's going to kick it off here. Give you all a brief overview of the three guys on the investment committee at Ironton Capital.
Yeah, this will be easy tonight because we're actually not talking about any of our investments. We're just coming up with some tools for you to free up cash so you can invest if you want to. But there's Vital, Alien, and Brent Geyer who are on the investment committee along with me that help to pick out the different investments that you pick. Really our goal for tonight, I'm going to turn this over to Joe to kind of run this discussion, is I frequently hear from investors that I've bought rental properties 5-10 years ago. I've experienced a lot of appreciation. They've doubled or in some cases tripled in value. Meanwhile, I've made incredible progress in paying down my loan. And now I've got all this equity that's tied up in the property. In some cases, I can help you guys do the analysis and figure out, does it make sense to sell the property, pay the taxes, and then reinvest with us or the stock market or whatever other vehicles you're thinking about. And I'm always available to do that analysis. But sometimes there's a longer term strategic reason why you want to hold on to the property, and selling it does not make sense for you. So I've been looking for partners that could figure out ways to do a second mortgage on an investment property, which is not a financial product that's very broadly available. And I was like so excited when I met the guys at Blue that they've got some products that might help for that. So we're going to talk about that tonight. And then Joe Massey's that can also help you get the equity that's been trapped in your property out so you can redeploy it. And then we'll spend a little time talking about what kind of wealth accumulation might that result in for your family over a 5 or 10 year period. So that's our goal today.
Outstanding. Well, let me go ahead and take a moment here. What we're going to talk about is an analysis on exactly what Lon just said. Hey, I've got a property. I've owned it for a long time. I've got a lot of cash or a lot of equity that's built up in the property. Maybe I like it. Maybe I want to sell it. Maybe I want to take some cash out. Maybe I want to do a home equity line of credit. How can I do that? And so we've put together a spreadsheet that we're going to go through today. And the very first question that everybody's going to ask, can we send out a copy of the spreadsheet? The answer to that is no. So if you want to look at your individual situation, you would want to reach out to Nick or reach out to Lon and schedule a time with them they'll ask you some of the interview questions, which we're going to go through a little practice interview with Lon here, but they'll ask you some of those questions and really put together a customized template of what it would look like for you. So you're welcome to ask, can we send out the spreadsheet? Unfortunately, no, because there's a lot of proprietary information here. There's a lot of moving parts from a regulatory standpoint, from, getting a loan from me, from getting a loan from, Stacy and the folks over at Blue, from selling your property, and of course, all the regulatory challenges, with Ironton, the SEC, et cetera. This is something that's going to remain in the hands of myself, Stacy, Lon, and Nick. But if you want to look at your individual scenario, please, please, please reach out to Nick, reach out to Lon. That is what this entire tool is here for. So let's go ahead and do a screen share and talk about this. So this is a spreadsheet that we've put together, Ironton Capital, as well as us here at Castle and Cook Mortgage, to talk about what if you want to take cash out of a property? What if you want to get a home equity line of credit on your property? What if you want to sell that property and reinvest the funds over to Ironton Capital? Now, can I get one or two of you folks to just comment that you can see my screen? And I know maybe the print is a little bit small, but can you guys see it moderately clearly and read what we've got on the screen?
Looks good.
Yeah, that looks pretty good.
All right, great. So the very first section we've got here talks about what if we wanted to take cash out of the property. And this is real simple. There's only about maybe a dozen questions. When you speak to Nick or you speak to Lon, there's about a dozen questions that they're going to ask you. So Lon, you're going to be my guinea pig today. You're an investor and you've got a property that you've owned for X number of years, and you're going to make up some information, and we're just going to plug it in and see what would it look like if you keep that property and don't do anything with it. What would it look like if you take cash out of that property through a new first mortgage? What would it look like if you did a home equity line of credit and invested some funds with Ironton? What would it look like if you decided to sell that property? So you're my guinea pig, Lon. What do you think is the current value of your property?
So we'll do 63, 64 Penrose. So let's say it's 675,000.
675,000 is the current value. Yep. Now, we talk about this a lot. How much do you think properties are going to appreciate over the next 5 years? We've had, 10, 20, 15% appreciation in recent years. This year and last year was maybe 3%. What's your projection, if you're an investor, that you think this property is going to appreciate per year for the next 5 years?
Well, it's going to be a lot less than the historical average because we've had such a huge run up lately and the average income hasn't gone up as fast. So I'd say 3 or 4%. Let's say 3.5.
3.5. Okay. I like that. Now, you've got a loan on this property, I'm assuming. What is the
about
current
250.
balance? 250. All right. And do you know the payment? Just the principal and interest, not escrows, just the principal and interest payment.
I don't have it handy, but the initial balance on it was probably 300, and I think this loan's at actually about 3.5% is the interest rate on it.
So maybe $2,200.
Yeah, about that. Sounds like it's your first time doing this.
You know what? I just like making up numbers.
Yes.
Now, this next one's a little bit of a challenge. The annual net operating income. Do you know the approximate net operating income, which for those of you listening, I know Lon knows this definition, but that is your income minus all expenses, but not including the mortgage payment. So if there was no mortgage payment, what would the net operating income be on an annual basis?
This one, it's actually an Airbnb, but let's pretend it was a long-term rental, just because that's probably what most of our audience is thinking about. Wow, we got 37 people on. This is great. Why don't we put in 15,000? Actually, it'd be before the mortgage. So let's say 15 plus 15. Let's say 30,000.
30,000. All right. Oops, not 3,000, 30,000. There we go. So your current monthly cash flow, approximately.
If it was a long-term rental, that's about what it would be. It wouldn't be a lot.
Be about right. Okay. Yeah. So about $300. Now your marginal tax rate, 22%, 24%, 32, 35, 37.
Probably 35.
35. Okay. All right. So if you do nothing with this property, what we've got over here is in 5 years, this property is going to appreciate from $675,000 at 3.5% per year up to approximately $801,000.
Okay.
Your loan balance is going to pay down because we're assuming you have a principal and interest loan. Over the next 5 years, that's going to pay down to approximately $241,000. Your cash flow over the next 5 years. Now, this is really important. We're not assuming any rent appreciation. We're not assuming, inflation. This is just taking multiplication. So we could make this really complex, but we're just assuming, kind of worst case scenario here. Over the next 5 years, your property is going to accumulate about $18,000 in cash flow. You're going to have a net gain on this property. The property is going to appreciate. You're going to pay down principal, and you're going to get tax benefits. And the true cash tax benefits based on your marginal tax rate is approximately $169,000. So we're going to add this appreciation, principal reduction, and depreciation to the cash flow. Over the next 5 years, you're going to receive approximately $187,000 in return on that investment. Makes sense so far?
Yeah, and the ROI pre-tax of 9%, that's probably about right. If it was a long-term rental, no doubt.
So for those of you watching, the way we're calculating that is this is the amount of return you're going to get. This is your current equity, $425,000. All right. That's the current equity that you have. It's going to appreciate. You're going to get this much in return. That's roughly 8.5% per year. But after taxes, you're going to be roughly 5.4% return on investment. Making sense so far?
Yeah, that's really good.
All right. So now let's say we want to take cash out. We want to do a new loan. Now this is self-serving because I love doing new loans. But you want to take 75% cash out. That's the maximum amount of cash out that you can take on an investment property. So that would be this $506,000 over here. There's going to be some closing costs, generally 3%. And let's just say you did this today. A cash out investment property loan would be roughly 7.125.
Okay.
So what does that do? Is that gives you a lot of cash out, all right? And your monthly cash flow does change a little bit, but you're getting a lot more cash. Now, why did that? Your monthly cash flow will change a little bit, but now you've got $241,000 would be the maximum that you could invest into Ironton.
Okay.
Okay. So once we take that cash out, we invest it into Ironton. This property is now losing money, right?
Yep.
So this property is now losing $911. So it was making $300 a month. Now it's losing $911 because we're taking that maximum $241,000 cash out. So
we're
what
basically doubling
happens
the
over?
debt.
What's that?
We're basically doubling the debt. So yeah, that makes sense.
Exactly. So what happens over the next 5 years? Well, our loan balance, let me back up. Our value continues to go up. The value doesn't change because the value and appreciation doesn't change regardless of the loan. But our loan balance in 5 years is about $477,000. Now, our 5-year cash flow is now negative, right? We're losing cash of about $911 a month. But from this property, we're still getting appreciation, we're getting principal reduction, and we're getting depreciation. So we're getting a little bit more of a return because we're getting more principal reduction. So that's why these two numbers don't line up, because portion of that is the principal pay down. Then we're going to take these funds here and we can invest them in the medium-term fund at 12%. Over the next 5 years, we would get a $183,000 return from Ironton. Or we could invest it in the long-term fund at an estimated annual return of 18%, getting us roughly $310,000 return. So when we add all of these numbers together, if we were to take that cash out and invest into the medium-term fund, we'd be getting a $319,000 return. Or if we invested into the long-term fund, we'd be getting a $445,000 return. On a pre-tax basis, it's more than double. It's 15% in the medium-term fund, 21% in the long-term fund. After taxes, because you will have to pay taxes when your return or when your investments begin generating a return, it's about 9% for the medium-term fund, but a 13% for the long-term fund. So what, 2.5 times return? And you still own the property. Property's still appreciating, but you've taken some cash out in order to invest over with Ironton. Now, the last step You might say, well, I don't really like having negative cash flow. So Lon, tell us a little bit about the medium-term fund and how that works. So we put money in there, it generates a return of approximately 12%, but then we actually receive a dividend check on a quarterly basis, right? Can you tell us a little bit about that?
Yeah, so imagine that you took out this 250,000, and maybe you were going to put 100,000 of that into the medium-term fund, and then take the other 150 and put it into the long-term growth fund. So that medium-term fund would pay 12%. It depends a little bit on how much you invest with us. The more you invest, that determines the interest rate. For sake of argument, we'll say it's 12%. So you'd be getting paid $12,000 over the course of a year, or about $1,000 a month. In this example, we've got negative cash flow because of this new mortgage of 900. So the 100,000 invested in MTI would generate enough cash to be able to fund all that for you. So basically, all the growth on the long-term fund you'd be getting for free.
That's exactly right. And so that number is represented right here. How much of this $241,000 would you need to put into the medium-term investment fund in order to break even? $91,000. Okay. And then you would have a remaining, what would that be? $150,000 that you could put into the long-term fund.
Right.
Now going down a little bit, this is your before tax projected return. So in orange is current, right? If you don't do anything in 5 years, you're going to have a value of about $612,000 for that asset.
Can you maybe zoom in just a little bit?
Yeah, you bet. Let me.
Oh,
that better?
That helps a lot. Yep.
Okay. In 5 years, you're going to have about $612,000 on your current strategy. The medium-term fund, you'd have about $744,000. On the long-term fund, you'd have about $870,000. And the starting point is the same on all of these, which is how much equity do you have currently?
Got it. So this is a way for a person to keep their asset, make about an extra $250,000, and it's going to take them 3 hours to do a loan application with you to get access to it.
That's exactly right. That's exactly right. After tax, because there's going to be some taxes, if you don't do anything, you're going to have about $546,000. If you were to take that cash and put it into the medium-term fund, you'd have about $632,000. If you took that cash and put it into the long-term fund, after paying Uncle Sam, you'd have about $714,000. So again, about $175,000 more after paying all of the taxes associated with this. So
perfect.
Let me pause there. And Lon, you're not off the hook. You're still my guinea pig. What question?
If you guys go to the chat field on the right-hand side, please type in your questions. Definitely try to answer these for you.
Joe, I got a question for you. The top right corner there, projected ROI in 5 years. We've got 15% for midterm fund, 21% for long-term fund. How do we go from the 12 and 18, where it says midterm fund at 12% for 5 years, long-term fund at 18% for 5 years? Can you walk us through how we go from that to the projected ROI of 15 and 21? Where does the 3% increase come from?
It's because you're still owning the property.
Got it.
So you're still getting the benefit. You've got negative cash flow, but you are getting the benefit of appreciation, principal reduction, and depreciation on the property. So you're getting return here as well as return from the medium-term fund. So these two numbers are giving you this total return minus your negative cash flow.
So it's the cumulative return of keeping the property and investing in the medium-term fund, or keeping the property and investing in the long-term fund, correct?
That's exactly right.
Understood.
Yep.
Thank you.
Great question. All right. Well, let's go ahead and flip over to our next tab here. And let's say, we walk you through this, Lon. What's the number one objection you might have?
Well, I've got a great rate at 3.5 right now. Is it possible maybe I could keep that but get a HELOC instead, or maybe a second mortgage?
That's exactly right. So that's the big objection that we hear. I don't want to do anything. I hear this all day, every day. I'm never moving. I'm never selling my investment property because I have a super low rate. Okay, cool. Let's talk about a second mortgage. And that's why we have our friends from Blue Credit Union here on the phone or on the call. So everything up here at the top doesn't change. This is what happens if we do nothing. But now down here, we see hey, we want to maybe take a home equity line of credit to 70%. So Stacy, let me bring you on. What's the maximum, if I own an investment property, the maximum that I can borrow on a HELOC second mortgage?
Good question. A lot of traditional industry standards are about 70 to 75%. Some will stretch up to about 80% if it's a HELOC. In the cases where you're borrowing in your individual name, you have more flexibility to go up to that 80% range. If you want to keep it in an LLC or a corporation you already have as a holding company for your properties, you're looking in that 70 to 75% range.
Okay. So for argument's sake, let's say we're limited at 70%. Now, this gives us a little message that says, hey, we can't go above 70% because back here we said we wanted to go to 75. And we've got a little note here. What's the maximum cash we can take out on a HELOC? $218,049. Let's see what that does over here. What do you know? Now we can take out that $218,000. There's probably going to be some costs associated with it. I know, every HELOC lender is different. We've assumed that it would cost roughly 2% for your home equity line of credit. Now, tell me a little bit, Stacy, about interest rates. Prime interest rate is currently what, 8.5%? Is that right?
8.5%.
Okay.
Yep.
And if I want to take out a HELOC on an investment property, I'm assuming there's going to be something above that, or tell me how that works. What type of interest rate might I expect?
Joe, you're typically looking at about prime plus a half or even higher. It's typically dictated by your personal credit score. Strongest credit score is going to be a 750 and higher. So, and as that prime rate may adjust, go up, go down, that margin based on your credit score is going to stay the same throughout the duration. Now, the great thing is a HELOC will bill you for interest only. You have some flexibility in payment. So you're feeling a little bit more wealthy in 1 month. You can go ahead and apply as much as you like towards principal balance, use your HELOC again. In those months, let's just say holiday timeframes, kids going to college, you need to make just that minimum payment. You have the flexibility of paying just the interest for the month and still satisfying the obligation.
Okay. So the prime interest rate is 8.5%. plus a margin of 0.5%. So would it be fair to just say an interest rate of 9%?
Very fair.
Okay.
And as the Federal Reserve lowers the rate a little bit, that would reflect like 30 days later, something like that on this rate too?
Yep. Typically, once your statement cycles, you'll see that change in there as well. Every 6 weeks is when that rate is evaluated. So it's stayed pretty flat for a period of time. Typically, when they lower it, they'll do it in some small increments, maybe 25 to 50 basis points. So that's about 1/4 to 0.5%. But it is fluid. And some home equities actually allow you to fix your loans within that line of credit too.
Okay. So what we've done here is we've said we're going to take out a new HELOC up to 70%. Now, my new payment is $2,200 on the first because Lon really likes that 3.5% rate. Totally cool. The HELOC is going to have a payment of the difference between that $2,200 and this $3,869. So approximately $1,669 a month. So that's going to give us negative cash flow of about $1,369. Now, over 5 years, what's going to happen? Well, the first mortgage hasn't changed. So that first mortgage is going to continue paying down to roughly $241,000. Stacy touched on earlier that HELOC balance, if you're making interest-only payments, is going to remain flat. If you want to pay that balance down, you have to make extra principal payments. What does that do to my cash flow? Over the next 5 years, we're going to see negative cash flow of roughly $82,000. The property is going to continue to appreciate. We're going to get principal reduction and depreciation. And now we can take that $218,000 and we can put it into the medium-term fund, which is going to generate us a return of $166,000, or put it into the long-term fund, which is going to generate us a $280,000 return. Combine that with the negative cash flow, combine that with the benefits of owning the property. In 5 years in the medium-term fund, we're going to be generating a pre-tax return of 11%, or in the long-term fund, a pre-tax return of 17%. So in this case, we're still beating the scenario of doing absolutely nothing by 2% on an after-tax basis, or by more than double in the long-term fund on an after-tax basis. And so what we see over here I'm going to zoom in a little bit. In 5 years, by taking out that home equity line of credit, or if we do nothing, we're going to have about 600,000, 612,000. Or if we do the medium-term fund, we're going to have about 678,000. Or in the long-term fund, about $793,000. After taxes, we're going to be making, as much as $40,000 to as much as $120,000 more, simply by using the benefits of a home equity line of credit over at Blue Credit Union.
And this is really the most cautious way of thinking about it, because we're assuming there's no reductions in interest rates for 5 years.
That's right.
So if the rates do go down at all these numbers would improve from there. Like if you were to take that 9% to 8%, like what kind of impact does that have?
I mean, you make another $5,000-$6,000 after tax.
Yeah, it really helps a lot.
Yep. And if that HELOC were to go down to 6%, now you're making, significantly more. So that's the tricky part, right? Is this rate is not static.
Yeah.
Yep. Now, I personally think that, the prime interest rate is about as high as it's going to get. I don't see anything in our future that's going to show prime interest rate increasing anytime in the next year. 5 years from now, tough to say, but I do feel like exactly what Lon said, this is a pretty conservative estimate, and kind of a worst case scenario that if you do nothing, you're going to generate about a 5, almost 6% return, or looking at taking some cash out, you're going to generate 11%, maybe more if interest rates go down. And here's the thing. You still own the property. You're still getting rent. You have some negative cash flow. So that's something you have to swallow. Or what we touched on earlier, of this $218,000, you could put $136,000 into the medium-term fund. You're going to get a check every quarter that's going to pay back that negative cash flow. And then the difference you can put into the long-term fund. So let's pause there. I did see a question here. Can losses be offset against other income in the fund if the fund underperforms? That is way above my head. Lon?
So there's probably two components to that. So the first would be to talk to your CPA to figure out your current mortgage interest is probably entirely deductible as a business expense. So your rental income gets deducted or gets smaller because of the interest payment. Would you be able to refinance the entire mortgage? Would you be able to keep the existing mortgage, take a second mortgage, and with those changes in interest still be equally deductible for you? I think in almost every situation the answer is going to be yes, but do please double check with your CPA before you take any action on this. And then for our funds, the income fund is going to just generate income for you. That'll be taxed as income, of course. The long-term fund, our goal there is to generate as little income as we can and generate as much as we can on the capital much down the road. So hopefully you wouldn't generate a whole lot of tax liability for the first 3 years. It would be a ways out. We do have an option with the long-term fund. There's 2 share classes. So the first class pays a little higher preferred interest rate, but it does not get any depreciation loss. So for people investing with a self-directed IRA, that's always like a really good choice. In this case, it may or may not. You'll want to check with your CPA to find out. The other share class gets a slightly lower preferred return, but it gets all of the depreciation. So when you've got someone who's selling an investment property and they're going to realize a capital gain and then take the proceeds to invest in the long-term fund, the depreciation class is almost always the right answer because we can use that depreciation. Again, check with your CPA to offset the gains on the sale. So in this particular case, it's not exactly clear on your situation what would be best. So Austin, you and I can just jump on the phone sometime and brainstorm about that, or we could talk with your CPA and figure out which of the 2 share classes would be most optimal for you. Pretty much everybody on the call will have a slightly different configuration probably.
Yep. Excellent question. Any others before we move on to our third section here?
This is a really great way to explain a complicated topic, Joe. I mean, this is fabulous.
Good. I'm glad you guys like it. All right. So Lon, you're back to being my guinea pig here. And
I'm trying to sell the thing. I'm tired.
Right? You just want to sell it. I'm just tired of it. It's got cockroaches. I don't want it. All right, cool. So on our last tab here, we've got the same information up here. What happens if we don't make any changes? But now let me ask you some questions, Lon. What was your original purchase price when you bought the property?
About 450.
And the approximate date that you bought it. I don't need exactly, but if you know month and year.
It's been about 5 years exactly. So we'll say July of 19.
All right. So what that does is this begins to establish your basis. All right. So we're assuming a 450 original purchase price. You've owned that property for approximately 5 years. This is the amount of depreciation that you've used. And so, Lon, I might ask you to talk a little bit about depreciation recapture, because depreciation, as I understand it, is lowering the basis of the property because you are getting that tax benefit in every year. And so when you sell the property, that your basis has gone down by the depreciation that you've used. Did I explain that well?
Yeah. So one easy way to think about depreciation is that it's an interest-free loan from the IRS for as long as you own the property. So the way you'll calculate on your Schedule E each year of your tax return is you've got this rental income that's coming in. You've got all these different expenses like your taxes, insurance, HOA, what you pay for, shoveling the snow and mowing the grass and repairing things. And that gives you some net operating income. And then you get to deduct your mortgage interest, and that would generate the cash flow of the property in reality. The IRS also allows you to put one extra deduction on there for depreciation. So I won't burden you right now with the calculation for how you figure that out, but basically you're going to write off a large percentage of the value of the property over about 27 years if it's residential, like this example would be. So your tax liability is a little bit smaller every single year, and you save some money because of this depreciation. And the IRS and your CPA will keep track of how much of a benefit you've gotten from this. And then you just are promising basically that when you sell the property, you're going to give that money back to the IRS. And that process is called depreciation recapture. So that's one tax liability you will experience when you sell the property. The second is the property probably went up in value. So you bought it for this much, maybe you spent this much on renovation, and then you sold it for this, and then you had some sales costs that bring it down. This difference here is how much did the property increase in value over the lifetime that you held it. And of course, you'll pay capital gains tax on that as well. So that's really what Joe's getting at here is the depreciation recapture as well as the capital gains.
Yep. So that depreciation recapture is kind of a cost. When you sell the property, Lon, you've owned a real estate company for a number of years. There's always cost to pay the buyer's real estate agent and the seller's real estate agent. Although that may be changing in the future, but for purposes of today, it costs roughly 6% to pay real estate agent fees. Is that correct?
Yeah, that's a good ballpark. And you guys can adjust that if you've got it. A lot of people on the call are realtors. So They may not have a listing fee. They may only have the buyer side. So of course we can adjust that for you.
And then you're going to have other fees, right? This is
title insurance, and
title insurance.
The buyer might have an inspection objection. They want a new stove put in or fix the leak somewhere. And there's always something you're going to pay.
There's always 1% of just junk that shows up.
Yeah.
Now, after selling that, you're going to have capital gains, and you're going to pay approximately $21,000 in capital gains. So after all of these expenses, your net proceeds are $356,109. Now, what if you said, as Lon did, I am so tired of this property. It's got roaches. I hate it. I don't like it. Tenants don't pay. I want to take those sales proceeds of $356,000 and fully invest that into Ironton. So you're going to take that full sales proceeds, roll it into Ironton, and this is after paying the taxes. Well, if you were to put that full $356,000 into the medium-term fund, over the next 5 years, it's going to generate you $271,000, which is a 12% return pre-tax. If you put it into the long-term fund, that's going to generate you $458,000, which is a 21% return. After tax, that's an 8% return in the medium-term fund, a 14% return in the long-term fund, compared to keeping the property, doing nothing, calling Orkin every month to go out there and deal with the cockroaches. You're getting a 5% or almost 6% return. So in either scenario, you're getting 3% higher or nearly triple and nearly more than double in the long-term fund, and you don't have the hassle of it.
Yep.
Questions on that?
No, this is great. And every single scenario is going to look a little bit different, but now you've got the facts that you can make a really well-informed business decision about what you should do. And do nothing is almost always not going to be your choice.
That's right. Now, one really important point. If we were to sell this property right now, it's generating $300 a month in cash flow. And you might say, hey, I really like that cash flow. I don't want to sell it because I enjoy the cash flow. Okay, no problem. If we were to take $30,000 and put that into the medium-term fund, we're going to get a check from the medium-term fund of $900 every quarter, which equates to $300 a month in cash flow. So take $30,000, put that in the medium-term fund, take the remaining $326,000, put it into the long-term fund. You're going to be generating the exact same cash flow, but a heck of a lot higher return over the next 5 years. And that's represented down here. The orange line is where you start. Now, keep in mind, the green line and the blue line, which represent the long-term fund and the medium-term fund, you start out lower. The reason being is because you've got a higher amount of equity. If you do nothing, selling the property, you have some costs. That's the difference. Oh, let me zoom in so you guys can see a little bit more clearly. The difference between your two starting points is the cost of real estate costs, junk, capital gains. That sets you back a little bit. In this case, about, $60,000, almost $70,000. But what happens 5 years down the road? You've generated $200,000 more in that long-term fund, or in the medium-term fund, you've still generated $15,000 more and had zero hassle, because there's not a lot of hassle with your long-term and medium-term funds. Is that right, Lon?
Yeah, I mean, you're not doing screening tenants and fixing things when they, wreck the property. And the 12 new laws the Colorado legislature passed for landlords in the last 2 years, you don't have to fight that anymore.
Yep. So over here on the after-tax side, you can see, again, the long-term fund clearly outweighs. The medium-term fund is not great, not as good from a dollar standpoint, but over a percentage standpoint, you see the slope of the doing nothing line stays low, whereas in the medium-term fund, they're going to cross probably in year 6, and you're going to have a heck of a lot more money in year 7, 8, 9, 10.
That's really typical for what we see when we do these analyses, is that in the first 3 or 4 years, do nothing or medium term will be really similar. And over a 10-year period, the medium term fund will do a little bit better and you don't have the headache.
Yep, I agree. Now, we had a couple of questions here, Lon. Ann asked, how do you define long-term fund and medium-term fund with both at 5 years? Can you touch on that?
Yeah, the medium-term fund, you have to be in it for at least a year. And then after a year, you can get out of the fund and get your cash back if you need some liquidity reason, like sending a kid to college or something like that. So you could stay in it for whatever period of time that you want to stay in it. The fund will actually run for 10 years. And then you'll have another fund like it right after that. So you could roll your money over if you're enjoying the results. The long-term fund, the goal is to get most of your cash back by the end of the 4th year, and most of the profits are in year 5 and 6. And if you're enjoying it, you could roll it over into, right now we're on fund 8, you could roll it over to fund 17 or whatever we're on at that point in time. Or, if you've got some other cash need, of course, you could redeploy it however you see fit.
Yep. Now, there was another question. What happens in the event of default if you refinance the property? So back over here, you've taken cash out and you default 1 year, 2 year, 3 years down the road. That is uncomfortable for everyone. What would happen is we would foreclose on that property. And so all of the returns you're getting up here would go away. However, you've already taken the cash out. We're going to foreclose on the property. You would still have your investment here. Just to be clear, Lon, if this loan were to default, we, the lender, we're going to take that property back, but that does not impact the investment into Ironton in any way. Is that correct? Oh, Lon, did we lose you?
So you turned his camera off right when I'm about to speak. So I can answer that.
Yeah.
No, that will not affect it. However, if you're in a situation where you do go into foreclosure and you sell it for less than what's owed, you may need to liquidate your investment, but it will not impact the investment sitting at Ironton Capital.
but not a great thing. So that's really an important point. This number here is in red because that is now negative cash flow. You need to have a plan to make sure you're covering that cash because that property is no longer generating money on a monthly basis. Now let's take that one step further. Stacy, if we were to do this plan with you and we take out a HELOC, if we were to default, what would happen?
Great question. I was wanting to jump in there just because we're seeing that happen so much more nowadays. And I wouldn't say the default, but the pre-default, right? People have started to really go through their savings accounts. They've depleted some of their liquid assets. And I think we fortunately got to experience forbearances, deferrals through COVID, where there was more flexibility in the financial institutions to work with the borrowers. That mindset is still there with many institutions. So if you start to see a strain, a stress globally within your household or your ability to service your debt and your investments, I would encourage you to reach out to your lender directly and see if there is an opportunity to do a modification or even perhaps a refinance. We happen to have a family right now that it doesn't work. They didn't want to give up their 2.75 rate, but we were able to find a solution refinancing them in the 4s to find a way to make sure the property didn't default and they could carry that on. So I think partnership with your lender, finding a relationship where you can pick up the phone and call somebody and have a resolution from start to finish is very important if you start to see some type of strain in your cash flow with your investments.
Absolutely. Now, before we swap back to the PowerPoint for the last couple of slides, any final questions or anything we did not cover? And panelists, I mean, is there anything I missed? Anything I left out? Anything you said, Joe, I disagree with any of the math?
I did want to highlight something, Joe. Can you go back to the sale tab?
Absolutely.
So this is a question I get quite often. We've got a lot of investors who have acquired a very healthy portfolio of properties that are low leverage or perhaps paid off. And their plan all along, right, was to pay those properties off, live off the cash flow. But what they found is that their equity is not working most efficiently, right? And so that's why this is really coming up. So I want to highlight something here because the question I get often is, okay, I'm selling my property, but I need some cash flow. How can I game this where I can put X amount of dollars into NDF and Y amount of dollars into something that will give me the cash flow that I was otherwise getting that I'm not getting anymore? And so I want to highlight, I believe it's in row 36 based on what I'm seeing, the $30,000 there in Lon's situation. That is the minimum amount that he would need to invest in MTI to achieve the cash flow that he was getting on his rental property. Is that correct?
Yes.
Okay.
So this $300 a month is the cash flow, which equates to putting $30,000 into the medium-term fund. Now, let me take that one step further. I really like what you said there. Let's say the current loan balance is 0. I bought this property and I've paid the loan off. So 0 loan balance and monthly principal and interest would of course be 0. Now this property is appreciating, cash flowing $2,500 a month. If I sell this property, I'm no longer going to have this $2,500 a month. And you hit the nail on the head, Nick. I really want some cash flow. Well, I can put $250,000 into the medium-term investment fund. What do you know? That's going to generate me $2,500 a month. And I still have $356,000 that I could put into the long-term fund. Where's that going to get me over the next 5 years? I'm going to get a 15% return on that money after tax.
Fantastic.
Does that help?
Yeah, tremendously. Because a lot of the conversations we have, we don't have that immediate answer for them, right? There's some arithmetic that they have to figure out on their own, unless we're trying to figure it out for them. But you've got a plain, simple answer in one cell on this Excel spreadsheet, so that's hugely helpful.
Yeah.
Yeah.
And although this is a great conversation, I never actually plugged in and tested this if there was no loan. So we get 1 or 2 little errors. So I'll make sure I revise that for when you guys are working on this with clients. So that's the benefit of live TV, is there always something that comes up. So really good question. So panelists, Lon?
Can we give some time to Stacy to talk a little bit about the different products that she's got and kind of how Blue works?
Please, Stacy.
No worries. Thank you. No, we appreciate it. Actually, some things you pointed out, Joe and Lon, is things that actually they're terms I'm not scared of. So you mentioned potential negative cash flow. You mentioned depreciation, right, or interest. Those are actually things that are commonly added back with a lender when you go to borrow. So when you see the negative cash flow on the worksheet, there's actually positive cash flow hidden behind that when you go to borrow. So if you look at your dividends, your interest, your one-time expense, your depreciation, even capital gains, if those are recurring, those become sources of cash flow to be a strong borrower. So I know, Joe, you use that in your world as well. And so I think definitely to Lon's point, checking with your CPA, there is a tax strategy to this. You may want to show negative cash flow optically, so that way you can make sure you're strategically in a different tax bracket. I know we run into those quite often. But I would say as far as what to look for, a partner, there's a lot of flexibility these days, but I would look for partners where there's no prepayment penalties on your different borrowings, right? Sometimes home equities, like Joe mentioned earlier, they have hidden early closure fees or other things along those lines that may impact your actual cost of funds. Your ability to modify loans. So as your picture changes and your asset portfolio might grow, it might shrink, you might be liquidating properties. How can you modify or restructure your debt with your investment properties? I think is a critical piece there. And a common question we get these days is the cost of funds. Why are my rates so high? What's that tied to? I hear rates are coming down a little bit. There's two things that rates are tied to. One is actually going to be the government, right? The prime rate, the Federal Reserve will increase or decrease rates to control inflation. The other piece impacting rates right now is how much money is sitting in a lending institution. When COVID happened, we had a lot of money, a lot of extra money and stimulus money put into banks and credit unions where it was easy to lend out at a 2% rate, 3% rate. As people are plowing through their savings accounts and their discretionary income more so these days, there's less money for financial institutions to lend out. So I would say expect a few months delay from when rates would start to come down on the government side before the lending institutions start to catch up with their deposits on hand. Joe mentioned earlier, a great starting point is that 70% LTV. There's a few other things we look at then as well. So we look at just personal cash flow. How are you able to service your own household debts? We look at the property's ability to service its own debts as well, especially if you're taking out funds to reinvest. And then we look at that picture globally. What does that look like? And also, what does your liquidity position look like after that loan happens? Do you have enough cash on hand to still service a couple months worth of those rental payments, a couple months worth of personal mortgage payments? So we want to make sure you're in a really good position there. So you're not putting every dollar into the pot to make sure you grow towards that next strategy. And then the other piece too, I guess I would just say, the opportunity to earn the 15 to 21% on returns, having also overseeing the investment side of it within our organization, a great rate for us, stable year over year, is about 8% in a pretty reasonable market. And I know it's hard for people with real estate assets to let those go and rethink how to invest. So I think this is a great solution and a strategy for that as well. As far as specific products, like Joe mentioned earlier, people don't want to touch their first lien rate. You don't have to. We can actually help with a second lien line of credit. We do have the ability to keep the borrower in your LLC or your corporation name. That also helps with reporting. You're not going to see that on your personal credit bureau. So if you're starting to see 5, 6, 7 mortgages on your bureau, need to streamline it to maximize your asset picture, we can actually take it off that space so it's not reporting personally. And then finally, I guess I'd just say the ability to modify. So, as the environment does change, is there a way to bring that rate down, bring the margin down as rates would change in the future, or restructure your real estate that the loans are collateralized by? Those are probably some key things you should be asking your lending partners when you're considering what that next step would be with borrowing.
Yep, I absolutely agree.
Stacy, I know that 70 to 75% is loan to value is pretty typical on a rental property. I would imagine we've got a number of people on this call with a bunch of equity in their primary residence. Does that loan to value go up higher than 70 to 75% on your primary? Okay.
Good question. Yes, we can probably look in the 80 to 85% range for strong borrowers in that case. And at least with our organization, it's still permissible to borrow in an LLC or a corporation name in a second lien while you are still vested individually on your primary residence. So primary, secondary homes. As far as market geography and territory, I'd say take Colorado and Wyoming and draw a bubble around it. So you'll take, your Nebraska, your Kansas, circle that around Idaho, Montana, Utah, just put a circle around those two states. That's traditionally our lending footprint for where those properties can lie. But we will offer exception-basis locations for that. Texas is very hard, as we all know. It's its own country when it comes to real estate. But outside of that, we have the ability to have some fluidity.
It sounds like, I think I heard you said this would work for a second home, maybe up in the mountains then as well.
Correct. Yep. Second homes. And as far as how we see that asset picture when we're looking at just primary and second homes, we just kind of look at that global picture. What does the total cash flow look like rather than what that specific property or rental property is doing for itself?
Perfect.
Cool. Well, Lon or Nick, you guys want to take us through the last couple of slides here about working with Ironton?
Yeah, probably Nick, just the last slide, which is the summary slide, is probably all we need.
Yeah.
There you go. Perfect.
So this is a fantastic overview of the flagship funds that we offer at Ironton Capital. We've alluded to some of these in the analysis. So in the first column, you can see we have the National Diversified Funds. So these are our growth funds where we're investing in value add properties where we're buying something that's existing and forcing appreciation through renovations. We're investing in that, or we're investing in new construction. We're building something from the ground up. So primarily all invested in real estate are National Diversified Funds, and we're targeting a minimum of about 17%. As of late, our last fund is targeting about 20 to 23%. And given the investments that we're in and the timing of the market, we feel strongly about how we're going to perform on our current fund. This isn't a liquid fund, e-liquid, so not liquid at all. So the distributions come back as we sell, refinance, or offer cash flow on the property once the properties are finished. So it's a great opportunity, I think, if you have a self-directed IRA, or if you need depreciation because you sold a property this year, or if there's any capital that you don't need cash flow on, you've got free capital that you can deploy into something that's growth-oriented. National Diversified Fund is a fantastic option for you. And then from there, we've got our short-term and medium-term income funds. Short-term's primarily invested in, it's a hard money loan portfolio of about 200 to 400 active hard money loans throughout Denver and Salt Lake City. The total fund size is about $200 million, and we pay quarterly dividends, 8 to 9% a year. That divided by 4 is what you can reasonably expect for quarterly dividends. If you need your money back in under a year, we can get that to you. It is a very liquid fund, so we just ask for a 3-month notice, but we can often get it back to you ahead of time. So great alternative option for those that might be just keeping money in the bank at Chase, making 0.5% on their money. And then we got the medium-term income fund, also pays quarterly, does pay higher, about on average of 12% a year, pays quarterly dividends of about, what is that math, 3% a quarter. Non-correlated to real estate. A lot of our investors like this fund for that reason. So regardless of what's going on in the stock market, regardless of what's going on in the real estate market with what we're seeing now, we're acquiring medical accounts receivables. So that's a fixed 12% on average a year. Again, uncorrelated with what's going on in the market right now. And then the last one is our single asset fund. So from time to time, we'll invest in something local. We've got a West Colfax, Sloan's Lake 10-unit townhome project we're investing in that is not a part of the global NDF strategy. So every so often we'll have a couple of those projects. They'll be a little bit smaller. They'll typically be local here in the Denver metro area. And those are great opportunities, but they come about kind of randomly and when we find the right opportunity. So if that's something that interests you, we can put you on a list for those single asset funds. But if you have any questions about any of these four, or want to do an analysis of your own situation, Lon and I are available to discuss this in greater detail with you. So feel free to reach out to us anytime.
All right. I think that's everything I wanted to cover. I'm going to put my contact information in the chat. Stacy, Nick, if you guys want to do the same thing.
Stacy, do you have anything else you wanted to talk about tonight?
So that was covered. Well, I guess I would just throw out a few options to think about as well too. Most of the dollar figures that Joe was sharing as an example are going to be below 400,000 when you're trying to extract equity from a property. So
Right.
I would point out, I think the cost of doing this can actually be a little bit lower than estimations. I love always estimating high and delivering low. But when you're dealing with a property or a loan amount less than $400,000, it actually qualifies for an automated value, a desktop valuation, so you can streamline some of this without having to do full appraisals as well. Yeah. So again, to all the points you gentlemen have made about chatting through your individual picture, I think that's great. What I would encourage people to do is if you don't have it now, always keep a personal financial statement handy. And then always keep your schedule of real estate handy. Having those on hand make it easy for lenders to quickly identify and scrub and find solutions for you. So just an overview of what do you acquire it for? What is that current balance, gross cash flow, estimated net income on the property? Those are some things that make it an ideal borrower and also a very knowledgeable and creditworthy character when we're trying to get loans done quickly to help you achieve your objectives. So.
Perfect.
Great.
So Vipin had a question about cost to invest. All the returns we showed on that summary slide are after expenses. But if you've got some curiosity about some of the funds, just let Nick know which funds you're interested in. We can get you all the details on that.
All right. Well, that is everything I wanted to cover. Any final questions?
If not, you can set an appointment to talk to Nick or I at the http://irontoncapital.com/book now. We can help you do the analysis, and then we can put you in touch with Joe or the guys at Blue Credit, or of course you're welcome to talk to the lenders directly too. Whatever is most attractive to you, we're happy to try to accommodate.
Awesome.
Really grateful that you guys would take a beautiful summer night and spend so much time with us. Thank you for joining us tonight.
Yeah.
Yes.
Thank you all for the time.
Yep. Good job, Joe.
All the guys at Blue, thank you for being on with us too. I really appreciate your guys' time for this. Thank you, Joe.
Thanks all.
Thank you, guys. See you soon.
All right. Thanks. Have a good night.